So if you own ETFs, you need to listen to this show, or maybe not, because we're going to share with you the results of a most recent Morningstar study titled Mind the Gap 2024 that came to the conclusion that ETFs, or at least investor experience with ETFs, underperform mutual funds to the tune of about 1% per year over the course of the past 10 years. That's pretty significant when you start to think about that. We're going to give you some of the reasons that Morningstar gave in this study as to why that might be the case. So an important discussion coming up here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida region. Also a top 25 financial planning podcast, so make sure you check us out on your favorite podcast platform, or you can go to our website, nelsonfinancialplanning.com, and there you can see the icons that will immediately connect you to said channels on various platforms, including our YouTube channel as well. Once you're there, make sure you subscribe. Then that way you don't have to look for us again. They'll pop up automatically. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks, all of whom happen to be certified financial fiduciaries as well, that stand ready, willing, and able to help you improve your life with a successful and cost-effective financial plan. So this past week, we had one of our regular client educational meetings. We have those every quarter. So if you're a client of Nelson Financial Planning, you get to attend those meetings and kind of listen to economists or portfolio managers or similar folks that are experts in the industry that we bring in to help educate our clients as to what's going on. As you might well imagine, we had that meeting on Thursday, the day after the Federal Reserve cut the interest rate by a full 0.5%. We're going to have more on that here in just a second. But my goodness, that really did give us a lot of current information to talk about. And as we promised on last week's show, we are going to share with you, our radio and podcast listening audience, some of the themes that we discuss. See, if you're a client of the firm, you get to get that information ahead of time, and otherwise, you have to wait for the radio show and podcast. So we got 4 investment themes that we're going to be talking about that ultimately you're going to want to consider, particularly for the road ahead, really regardless of what happens to the election in November. But before we get deep into that, of course, the big news this past week, the Federal Reserve on Wednesday cut rates by 0.5 percentage point. Now, it was interesting because oftentimes they usually go in quarter point increments to be sort of slow and not overly cut, or for that matter, overly increase things too quickly or too slowly. So it did surprise the markets a little bit to have that full 0.5 point rate cut. Generally, the expectation was around 1/4 point, although there were some folks that were hopeful for the 0.5 point cut. Obviously, when you cut rates, things like borrowing costs and things like that go down, so that's good. But the reality is that markets were sort of anticipating something. At the very least, 1/4 point, maybe the 0.5 point might have surprised some parts of the market. But the notion that when you think about mortgage rates are kind of tied into what the Federal Reserve is setting in terms of the overnight lending rate. And so what we had seen in the weeks leading up to that Fed meeting this past Wednesday, that mortgage rates were sort of already pricing in a reduction and sort of in anticipation. You saw the week before last where 30-year mortgage rates hit their lowest rates that they had been for about 2 years, all the way back to September of 22. So that ultimately increase the amount of refinancings and things like that. So a big uptick in terms of refinance. Perhaps sort of a classic case of, buy the rumor, sell the news, if you will, because the markets really were anticipating some kind of a rate cut. In the weeks leading up to that Wednesday meeting, we saw the markets sort of continue to kind of move upward. And then, of course, with the news, then there can be an increase in volatility. And that's what we want to talk a little bit about in terms of what that may mean for the more immediate road ahead. We've got those investment themes that we're going to be talking about for more kind of that longer term. But in terms of the immediate, obviously this is a bit of a transition period of time, right? So the Fed is either in a period where it's raising rates, where it's pausing, if you will, or where it is cutting rates. So we've just kind of entered into that third phase, if you will, in terms of the current cycle. Obviously, interest rate declines are generally correlated with spurring economic growth, or at the very least, lowering borrowing costs. Those transitions in time typically come with a little bit more volatility. Of course, the calendar isn't exactly our friend on that either, because here we are, a month of September, historically since 1928, the worst single calendar month for the market. And then if we look ahead to October, which of course is right around the corner, that since 1980 in presidential election years has generally been sort of the worst month in election years. So we definitely have some trends here in the calendar to kind of navigate through, along with this big transition by the Federal Reserve. So I guess our bottom line on that is that small doses, I guess, much like we recommend small doses of political news these days, might be good to take small doses of what's going on in the market, particularly avoiding checking it out, 4 or 5 times a day. That's probably good advice anyway, because if you're constantly looking at it, it really does make being consistent a little bit trickier. So anyway, this past week sort of kicked off our educational events for our clients. We certainly have a very full lineup, something happening just about every month around the office in terms of educational events or food drives or shred days or those kinds of things. And so we certainly believe, of course, in the power of education. That's something that we talk a lot about on this program. That's why we do this show and been doing this show now for decades. And ultimately, one of the reasons why we wrote the book, Next Gen Dollars and Cents, really kind of to help educate. We think that's very valuable for investors as a whole to really understand and appreciate what it is that they have. So if you're a client of Nelson Financial Planning, you know that we have an educational type of an event every quarter, so 4 times a year. But we had one obviously this past week. So without further ado, let's get into some of these investment themes that we were talking about. And we do believe that these are going to be important themes for sort of like the next decade, if you will. So that's kind of regardless of who wins the election, right? If you're kind of thinking out over the next 10 years, then it's not as material in terms of who wins or loses in terms of the election. So I guess the first comment in this, even with the rate cut, when we think about interest rates, and certainly while the Fed cut interest rates this week, we think that you're probably going to be in an environment where those interest rates are probably going to be a little bit higher than what we might have seen over the course of the past decade or so, right? You get interest rates down to 0 in terms of the Fed overnight rate. You get mortgage rates down below 3%. That's probably more of an aberration. And when you look at history, you'll find that the Fed rates typically between 3 and 6% for really the majority of the time, if you're looking at the past 150 years. So if your overnight lending rate's around 3% or so, then your mortgage rate's typically 5 or 6. Good for yield on bonds, those those traditionally higher rates, but not so good for savings accounts. Particularly this cut by the Fed probably has a direct impact on the amount of interest that you are earning in that savings accounts. And that's a key concept, and we're going to have some more thoughts on that right after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So we're continuing on our list of sort of 4 major investment themes that we think will have longer term investment implications for investors going forward, thinking about over the next decade or so. And obviously, if you are a client in Nelson Financial Planning and you were able to attend our educational dinner session last week, you probably heard some of this stuff already, but we thought it was so important that we wanted to spend some time sharing it with our radio show and podcast audience as well. So before the break, we were talking about sort of that first concept, higher interest rates, or should we say interest rates that are more in line with what we typically see in the majority of time. Not these 0% overnight lending rates, not these under 3% mortgages, but rather sort of that return to more normal rates of between 3 and 6%. So ultimately, from a bond perspective or from the conservative side of your portfolio, probably going to make a little bit more interest than perhaps you did over the prior decade or so when interest rates were basically zero. At the same time, though, probably not going to be earning on your money markets and savings accounts and CDs as much as you were just 2 or 3 months ago before the Federal Reserve cut rates by that full 0.5 percentage point, which they did this past week. So that really does kind of beg the question of, okay, well, in terms of where return is going to come from, where do I need to ultimately be positioned? And that's kind of what these investment themes are all about. So the second one we wanted to share with you is the conversation about dividends. And obviously dividends have always been a very important part of the market. If you go back over the course of the past 100 years, dividends generally contribute about 37% of the overall return in the markets over the course of the past 100 years. Past 15 years, though, it's only been about 17%. So you can see where it's not been normal to have dividends be that small or contribute that small of a proportion to your overall return. We think that story is going to change. One of the elements to that is that dividend-paying companies today generally have a lower PE ratio. We're going to talk a little bit about what that is here in just a second, but a lower PE ratio than certainly some of these technology companies and things like that. Now, what is a PE ratio? What is that? What's the beauty of having a low PE ratio? Well, when we think about PE ratios, it's price to earnings. So think of it this way. If you've got $10 and $10 buys you $1 worth of corporate earnings, right? So that would be a PE ratio of say 10. But what if you had to spend $20 to get that same dollar of earnings? Recognizing that how much a business makes, its earnings, is going to be pretty important to determining its future profitability. So what do you want? Do you want to pay $10 for that dollar of earnings, or do you want to pay $20 for that dollars of earnings? The answer should be self-evident, right? I only want to pay $10 for that earnings, which means then that PE ratio that would be 10 versus 20, that PE ratio would say, hey, there's perhaps better opportunity. Things are on sale, for lack of a better word. And so I'm going to look more for potential opportunities on that lower side of those PE ratios. Well, dividend-paying stocks generally have much lower PE ratios, particularly today, than sort of some of these higher tech, large cap technology types of companies. So this PE ratio is a pretty important concept, and actually was one that kind of kept percolating up to the front of the conversation during the course of our educational session this past week on Thursday. And it's an important concept. We certainly talk about it at length in our book, Next Gen Dollars and Cents, when we're talking about stocks and owning stocks and how you ultimately understand what's going on with a particular stock. Is one of the traditional metrics for sort of valuation is this concept of PE ratio. So think of it as that example. Do you want to pay $10 for $1 worth of earnings, which would be a PE ratio of 10, or do you want to pay $20 for $1 worth of earnings? That would be a PE ratio of 20. Clearly, you want to only spend, if you can get $1 worth of earnings for $10, hey, that's a better deal than $1 worth of earnings for $20. So hence the concept of the PE ratio and why it is so important. So when you're looking at where the investment opportunities are, and you see that dividends consistently over time have certainly been one of the biggest contributors to the overall performance of the market, and then at the same point in time, they haven't necessarily been contributing much of late, and they've got these lower PE ratios than a lot of the other sectors of the economy, it starts to suggest, hey, wait a minute, there's some opportunity here. So that's the important concept. And so to segue off of that, sort of our third investment theme is that their world is certainly full of more than just technology companies. You hear about the Magnificent Seven. Current market valuation is $12 trillion. So the combined value of those 7 large tech companies, $12 trillion. If you look at the next 42 largest companies, so that'd be companies like Eli Lilly, United Health, Chase, Berkshire Hathaway, the combined valuation of the next 42, so you got the first 7, 12 trillion. The next 42 are valued at 12 trillion. But here's the thing. The combined sales of those next 42 are nearly 3 times the sales of the Magnificent Seven, 4.7 trillion versus 4.4 trillion versus 1.7 trillion. So if you look at the next 42 companies, which basically have the same market value as the Magnificent Seven, but you've got 3 times as much sales with that next group. And when you look at profit, you've got double the profit, 100% more profit combined of those next 42 companies versus the Magnificent Seven. So that presents sort of a world of opportunity if you think of it from that perspective, because a lot of the earnings, a lot of the valuation already sort of priced into this small group of companies that really have been driving the market. The world is filled with other sectors besides technology that you may want to look at reintroducing into your portfolio in order to increase your chances of investment success over time. We've got one more concept that we're going to share with you. So welcome on in here to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida, one of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida region, also a top 25 financial planning podcast. If you would like us to take a look at what it is that you own to make sure that you're on the right financial track, go to our website, Nelson Financial Planning. There you can ask for an absolutely free, no obligation consultation at any point in time. We'd be happy to sit down with you and kind of give you a little bit of a second opinion, if you will. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. So to continue on with the themes, if you will, of what we think are going to be important, the last one, sort of speaking of opportunity and that there's a world of opportunity beyond just the technology sector. Well, there's a world of opportunity beyond just the U.S. And when we think beyond the U.S., that's also an important theme. Going back to this whole notion of market concentration and how just a small handful of companies have driven a lot of the performance of the market. When you look at the top 10 companies in the S&P 500, they've contributed 36% of the performance of that index of supposedly 500 companies. For the MSCI, that top 10 holdings only about 16%. So you can see where it's a much broader market. Anyway, bottom line, key takeaways in terms of these investment themes, of course, be consistent, be diversified. That always applies. But reevaluate, if you will, where your cash is, particularly in light of where interest rates are, particularly in light of this interest rate cut of 0.5%. You're going to see a pretty big drop in terms of savings rates, money market rates, CDs, things like that. And then lastly, be sure that you're kind of thinking outside the box, if you will. Some of these time-tested investment themes that we're talking about, the role of dividends, the role of a diversified portfolio where you're not just owning one sector, a portfolio where you're owning companies all over the world. These are some time-tested investment concepts that ultimately you probably want to take a look at and take advantage of in your portfolio, particularly as we think of performance over the course of the next decade. With that, we're going to take a break and return here on Dollars and Cents. This is Joel Garris of Nelson in financial planning. Coming up next, that study out of Morningstar that really debunks the value of ETFs to investors. So stay tuned on this one. This one's pretty detailed, and we'll cover that coming up next here on Dollars and Cents. So we've got the latest research on ETFs and why they may not be particularly good for your portfolio. Let's set the stage first, talk about what ETFs are versus your traditional mutual funds. So in a lot of ways, there's some similarities, right? ETFs are basically a basket of stocks, bonds, things like that. And so too are mutual funds. So they represent very diversified baskets in terms of ultimately what you own as an investor. But they also are a little different, right? So mutual fund holdings typically can change. In a mutual fund, you can own a company that is not publicly traded versus an ETF where all of the holdings have to be publicly traded. So there's no ownership of a private company or anything like that inside of an ETF. And ultimately, the underlying holdings don't necessarily change a whole lot. So recent research really concludes, this is courtesy of Morningstar, one of the appeals of ETFs, sort of what they were really designed for right from the very beginning, is in fact one of the things that undermines, or at least undermines, investors' experience with ETFs. See, ETFs were designed as a product that could ultimately be traded on a regular basis throughout the course of the day. And it's this notion of something that can get traded on a regular basis throughout the course of the day that ultimately, because of the very nature of how it is constructed, encourages people to trade and to move and to shift in and out. And unfortunately, ETFs have grown in popularity. Financial advisory industry in particular has really embraced these products. Over the past 15 years, more and more of the investing public's assets are going into these ETFs. There's now over $11 trillion with over 9,000 different ETFs out there. But it clearly is a product or an investment that is designed to be traded. And ultimately, that really does serve to undermine investor experience or investor results over time with these products. And so we're just going to read the straight out of the most recent study, and then talk a little bit about what those conclusions ultimately mean. So this is a study out of Morningstar, well-respected entity, and we're just going to read a couple of sentences about kind of how it all played out. So a new Morningstar report. And this is from an article in Barron's Magazine. A new Morningstar report titled Mind the Gap 2024, so obviously very current, analyzes the gap in performance between standard mutual fund returns versus dollar-rated returns, measuring how, so standard returns, meaning, okay, those just straight-up returns, versus dollar-weighted returns, which measure how investors who traded the funds, as opposed to simply buying and holding them, actually perform. So you've got, if you just own the thing and don't touch it, versus the actual investor performance owning the product. While there was a small gap for index mutual funds over the study's 10-year period of time, about 0.2 percentage points per year over that 10-year period of time, that wasn't true of index ETFs, where the average dollar invested earned 1.1% less per year than the fund's regular return. In addition, a 0.9%, so almost 1% per year return gap between mutual funds and ETFs. Now, that may not seem like a lot, but it's actually more than investors pay for many actively managed stock funds, negating one of the chief advantages of indexing. Folks, we've been saying this for years, all along. The more research that comes out on these products, look, these products are relatively new. Actively managed mutual funds have been around for 100 years. We talked about that earlier this summer on one of the programs where we recognize that the oldest fund in America turned 100 in July of this year. ETFs only around for maybe 15, 20 years. The data on them is just beginning to start to get compiled. Why? Because you need 10 years. You need 10 years of data before you can start to come to any conclusions on these things. This is a pretty significant underperformance as it relates to investor experience with these types of products. Now, the question becomes, why? So the folks at Morningstar, in particular this article from Barron's, speculated that there was, in fact, 3 different sort of reasons why you're seeing that underperformance when it comes to ETFs. First of all, ETFs are very popular outside of retirement plans. So if you think about mutual funds being very popular in employer-provided plans, things like 401ks, things like that, then ultimately when you're in that 401k or when you're on those 401k platforms, you kind of get like a Denny's menu of here are the funds that you have available to you. Pick one of them or pick a bunch of them, and that's that. And so what happens is then when people leave their employer plan and sort of go out into the universe, roll that account over, then you've got a universe of choices. And ETFs, becoming more and more popular, are just one. But the reality is that sometimes that universe of choices isn't really all it is cracked up to be. So the popularity of ETFs outside of retirement plans is sort of one piece of the puzzle. The second piece of the puzzle that the folks at Morningstar were pointing out is the types of indexes that ETFs usually track. So generally an ETF is going to be tracking a more narrower, specialized, often sector-based return. And here there's a whole nother conclusion of this exact same study by Morningstar entitled Mind the Gap 2024, where it determined that the more specialized funds wound up being even more volatile. And since they're ultimately designed to be traded regularly, I mean, that's the appeal, if you will, of ETFs. So you can trade them throughout the course of the day. Isn't that great? The problem is if you're trading more often, what tons of studies conclude is it's not really helping your investment performance. In this particular case, the more specialized those ETFs became, the greater that gap. So the gap in ETFs, over 3% per year over a 10-year period of time loss versus funds, which were somewhere like 1.9. Bottom line is the more specialized or the more sector-oriented you're getting, whether you're using funds or whether you're using ETFs, it leads to poorer investor behavior because you're always kind of a day late, dollar short, getting into something after it's already gone up, getting out of something after it has gone down. The third reason that Morningstar had sort of the speculation for why this misperformance for the investor experience when it comes to ETFs relative to the performance that they should ultimately be getting is the end clientele. I mean, if you look at kind of how and why ETFs were designed, the end clientele for ETFs is not the investing public. It's not the investing customer. It is, in fact, the financial services industry. It is the financial advisor, and because those products were designed specifically to be traded, to justify some of the high fees that we hear and see out there on a regular basis in the financial services industry. If I'm going to charge you 1.25%, 1.25%, or maybe 1.5%, or who knows what I'm charging, if I'm charging that, then somehow I got to come up with a product that allows me to justify that. Well, okay, great, fine. Maybe you're justifying the fee, but if at the end of the day, you're not actually delivering on the performance, doesn't that just kind of undercut the whole argument? I mean, as professionals in the industry, if you're a professional in the industry, in the financial industry, one thing should be kind of relatively apparent is like trading too much isn't good and doesn't produce good results, right? Warren Buffett talks about trading at the pace of a sloth as being the right trading level that you should be at. But ultimately, industries were, working hard to make it look like they're doing something that, in fact, reduces your return. Prospects, in fact, had this conversation and asked me the question of, what's the most important thing? Folks, the most important thing is performance. Okay, one of the biggest things that impacts your performance from an investing result is how much you're paying for it. It's that simple. We're going to have some more thoughts on this, but first we're going to take a break. So stay with us through this one. It's an important concept based on the most recent study and research that come out of the folks at Morningstar, looking at the the investor underperformance using ETFs. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So let's really go over this bottom line of the study that we were talking about in the previous segment here on Dollars and Cents. This is the Morningstar study that just recently came out. It's called Mind the Gap 2024. And it looked at the performance, or should I say the investor experience, the investor performance when they use ETFs versus traditional mutual funds. The reality is that those two products are somewhat similar in that they are diversified baskets of stocks and bonds, but there's some big differences. ETFs, by their very nature, were created and designed as a product that could be traded much more frequently than a traditional mutual fund. ETFs have become very popular. They've become very popular in the industry. Over $11 trillion over the past 15 years has been shifted into those types of products. There's over 9,000 different ETFs. The reality is, though, that you have to understand that there is now, based on studies courtesy of Morningstar, a gap in how investors actually perform using those types of products. And when you stop and think about it, it should kind of make some sense, because one of the things that we know about investing is it's important to be consistent, right? It's important to be consistent over time. So if you're being pushed by the financial services industry or your advisor into a product, an ETF, that by its very nature is designed to be traded more often, what do you think is going to happen? It's going to get traded more often. And guess what? When things get traded more often, you don't do as well. It's that simple. These products, these ETF products, were designed to be traded. They also were designed to help the financial industry justify the expenses that they charge, because it makes it look like they're doing something. Well, you know, just because they got a good story to tell a particular client doesn't make it good in terms of performance. The reality is stories are stories. Who cares? It's performance that matters most. And at the end of the day, when you think about it, who cares whether it's a good story or not? The answer is that they were designed to make the financial industry look like they were doing something because they can be traded more often. And then lastly, when you look at that Morningstar study, that's a pretty significant gap based on investor experience using ETFs, getting significantly less returns to the tune of over 1% per year. That doesn't even include the expenses of the financial services industry, 1% per year over the course of the past 10 years. So bottom line, as we say constantly on this program, make sure you're asking the right questions. Why do I have this particular investment product over another? What's the advantages? What's the disadvantages? What's ultimately investor experience using these particular types of products? The answers, or at least the answers based on research by Morningstar, are certainly going to surprise you. Some important things to be thinking about when we think about some of the investment products that are out there, because you got a slew of them to pick from. Better be careful of which ones you own. And that, after all, is a part of being educated. So another jam-packed show here on Dollars and Cents, highlighting that importance of being educated about not just some of the long-term investment themes that we were talking about earlier in the program, but also about what type of investment products you own and how they actually perform and what they were actually designed to do and why. Because at the end of the day, you may be very surprised at kind of what the real story is or what the real investor experience is behind these products. So to recap those four investment themes that we talked about earlier and why we believe that they're going to be important for the road ahead. Number one, we're in an era of higher interest rates. The 0% overnight lending rates, the mortgage rates under 3%. Look, that's not normal. If you look at history, typically you're in that 3 to 6% range the majority of time over the course of the past 150 years. We think you're going to find a more return to normal in terms of interest rates. The role of dividends, particularly when you look at dividend-paying stocks that generally will have lower PE ratios than more technology-oriented stocks. Remember our conversation about PE? It's a simple way to think of it. Do you want to pay $10 for $1 worth of earnings, or do you want to pay $20 for $1 worth of earnings? You want to pay $10. Why pay double for the same amount of corporate earnings? Because after all, corporate earnings, ultimately, that's your profit. That's your profit as an investor. Dividend-paying companies, much lower PE ratios, and also have been, over time, historically, a much greater contributor to long-term investment performance. Over a third, 37% over the course of the past 100 years. Of late, only about 17%. We think there's going to be a regression more to that normal, where those dividend-paying types of companies are going to be a more important part to help generate investment results. Third, look, there are other industries besides technology. You don't need me to tell you that, but the reality is that maybe your portfolio does, because it probably has gotten skewed to technology over the course of the past several years. Ultimately, that's the importance of wanting to rebalance and readjust along the way. And then don't forget, hey, it's a big world. There's other places besides the U.S. to invest. And certainly when we look at opportunities like PE ratios, things like that, we look at market breadth, less concentration. That certainly is much more prevalent outside the U.S. than it is inside the U.S. So some interesting stuff in terms of the overall investment themes to be thinking about, regardless of who wins the election. I think we're all going to get all fixated on that over the course of the next several weeks, understandably so. But remember, your investment should be positioned not to achieve a particular result over the next few weeks, but really to achieve results over the course of the rest of your lifetime. And let's face it, if you're going to achieve results over the course of the rest of your lifetime, you need to make sure that you know what investment products you own. Certainly a very troubling study by the folks at Morningstar about the major gap that investors experience when they're using ETFs relative to how well they would have done in just a traditional mutual fund type of an approach. The reality is ETFs designed exclusively to be traded more frequently than a fund. That is the very core of what an ETF is all about. Something that's designed to be traded more often generally is, and the more often you trade, the more likely you are to underperform the market. Certainly that's the bottom line of this results out of this Morningstar study entitled Mind the Gap 2024. Two other issues, of course, as ETFs have a tendency to be very narrow, very specific in terms of sector orientation, which further erodes the investor experience with those ETFs. And then don't forget the end client. The end client for ETFs is not the investing public. ETFs were in fact created for the financial services industry. That alone should stop and make you think about, what really is the role of this in my portfolio? Designed to be traded regularly, in essence, to justify sort of the presence, to justify that, hey, I'm doing something. But at the end of the day, if it doesn't yield better results and in fact yields poor results, then what's the point, right? So as usual, make sure you ask the questions. Why am I owning this particular investment over another? Why am I owning this particular investment allocation over another? The actual answer, if you can get the actual answer, may in fact surprise you. So some interesting stuff here on the program. And as always, we are open for conversation from you, our listening audience, to the extent that there is a topic that you would like us to address on the program that maybe we haven't addressed in a while. Actually, our conversation last week when Chet Coward, a fellow certified financial fiduciary at Nelson Financial Planning, joined us to talk about that fraud alert credit freeze type of discussion was actually courtesy of a listener who said, hey, can you talk a little bit about this? So we do, in fact, take those comments on the podcast and on the YouTube videos very seriously and use them as an opportunity for you to communicate with us as to what it is that you would like us to maybe feature in terms of a topic on the program. So don't hesitate to reach out for us on that. Similarly, if you got questions about anything that we talked about, or maybe you're about ready to retire, or maybe you're looking for a second opinion because maybe your performance hasn't been as good as it can be, give us a call to set up an absolutely free, no obligation conversation. You can do that by calling our office at 407-629-6477 or visiting our website, nelsonfinancialplanning.com. Remember, we don't charge for those conversations, and unlike so many other firms, we do not have account minimums. We believe in actually helping people where they are at rather than requiring them to have a bunch of money to talk with us in the first place. Isn't that interesting? With that, we're going to wrap it up and get it on out of here. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning.